Have you ever checked your stock portfolio late at night and noticed that your gains seem to happen while you're sleeping? It's not just your imagination. There's actually a fascinating reason behind this phenomenon. Today, we're diving into why stocks often gain value overnight, how you can use this knowledge to your advantage, and what it means for your investing strategy. Hey friends, welcome back to the channel. I'm Iggy from the Investing Iguana. If you're new here, I cover topics like stocks, finance, retirement planning, and everything related to growing your wealth. Fun fact, the Investing Iguana was ranked 8th in the 2024 Influential Tigers by Tiger Brokers, and as of December 2024, I've produced over 700 videos with more than 300,000 watch hours. My goal is to simplify complex financial concepts so anyone, anywhere, can understand them. Whether you're an experienced investor or just dipping your toes into the world of stocks, you're in the right place. So grab a cup of coffee or tea if that's your thing, and let's get started. Let's start with the big question. Why do stocks seem to move during non-trading hours? After all, when markets are closed, no one's actively buying or selling, right? Well, yes and no. While the trading floor might be quiet, the financial world never truly sleeps. Here's what's really going on behind the scenes. Have you ever woken up to a major news headline about a company? Maybe it's earnings results, a merger announcement, or even geopolitical events that could shake the market. News doesn't care about stock exchange hours. It happens 24/7. And guess what? That news has a direct impact on how investors perceive a stock's value even before the opening bell rings. Think of it like this. Imagine you own a bakery, and overnight, a famous food critic writes a glowing review of your croissants. By morning, people are lining up outside your door, willing to pay more for those buttery pastries. Even though your shop isn't open yet, the demand is already building. The same principle applies to stocks. When significant news breaks after hours, traders adjust their expectations, which influences pre-market activity and sets the tone for the next trading day. Now here's where things get interesting. While regular trading hours are typically between 9:30 a.m. and 4 p.m. Eastern Time, in the U.S., there's something called pre-market trading that happens beforehand. This session starts as early as 4 o'clock a.m. and continues until the official market opens. During this time, institutional investors, hedge funds, and other big players react to overnight developments. To put it simply, these folks don't wait around until 9:30 a.m. to make their moves. They jump into action based on whatever news they've digested overnight. For example, if a tech giant announces blowout earnings after the market closes, you'll see a flurry of activity in the pre-market session as investors rush to position themselves ahead of the crowd. But here's the catch. Pre-market trading tends to be less liquid and more volatile than regular hours. What does that mean for you? Prices can swing wildly because there aren't as many buyers and sellers participating. So while you might see some juicy gains or scary drops in the pre-market, don't assume those numbers will hold once the broader market opens. One of the biggest drivers of overnight stock movement is earnings reports. Companies usually release their quarterly results outside of normal trading hours, either before the market opens or after it closes. These reports include key metrics like revenue, profit margins, and guidance for future performance. Investors pore over every detail, trying to figure out whether the company is doing better or worse than expected. Let me give you a real-world example. Back in October 2023, Tesla reported its Q3 earnings after the market closed. The results beat analysts' estimates, sending the stock soaring in after-hours trading. By the time the market opened the next morning, Tesla shares were up nearly 10%. Now imagine waking up to that kind of gain without lifting a finger. Of course, the opposite can happen too. If a company misses its targets or issues disappointing guidance, its stock can take a nosedive overnight. Just look at Meta Platforms, formerly Facebook, earlier this year. Their earnings report revealed slower than expected growth, causing the stock to plummet in after-hours trading. Ouch. Another factor to consider is that the U.S. isn't the only player in the global economy. While Wall Street takes a break, other markets around the world are still buzzing. In Asia, Europe, and beyond, investors are reacting to their own local news and trends. And since global economies are interconnected, what happens overseas can have ripple effects on U.S. stocks. Here's a simple analogy. Picture a row of dominoes. If one falls in Japan due to an economic slowdown, it could knock over another in Germany, which then impacts the US. Let's say China announces weaker than expected manufacturing data overnight. That news could weigh heavily on US-based companies that rely on Chinese exports, causing their stocks to drop in pre-market trading. This interconnectedness is especially important for multinational corporations. Take Apple, for instance. A huge chunk of its revenue comes from international sales. If foreign markets experience turbulence overnight, Apple's stock price might reflect that uncertainty even before US markets open. If you think humans are the only ones making moves overnight, think again. Enter algorithmic trading. Essentially, robots programmed to execute trades based on specific criteria. These algorithms scan news feeds, social media, and other data sources for signals that could affect stock prices. Then, they act on those signals faster than any human could. For instance, if an algorithm detects positive sentiment about a particular stock in after-hours news coverage, it might automatically buy shares, driving the price higher. On the flip side, negative headlines could trigger sell orders, pushing the price down. It's like having thousands of tiny traders working around the clock, even while you're catching Z's. While algorithmic trading adds efficiency to the market, it also contributes to increased volatility. Those sharp price swings you sometimes see in pre-market trading, algorithms are often the culprits. Here's something else to keep in mind. Many investors own exchange-traded funds or index funds instead of individual stocks. These vehicles track baskets of securities, meaning their prices are influenced by the collective performance of their underlying holdings. Overnight movements in individual stocks can therefore trickle down to affect ETF prices. Take the S&P 500 ETF, for example. If several large-cap stocks within the index experience significant overnight gains, the ETF's price will likely rise in pre-market trading. Conversely, widespread losses among its components could drag the ETF lower. So even if you're not directly trading individual stocks, you're still exposed to overnight market dynamics through your ETF investments. All right, enough theory. Let's talk practical tips. How can you harness the power of overnight stock movements to grow your portfolio? Staying informed is crucial. Keep an eye on after-hours news and earnings calendars. Knowing when key reports are scheduled can help you anticipate potential price swings. Setting alerts can also be a game changer. Use tools like Google Alerts or brokerage platforms to notify you of breaking news related to your holdings. Being proactive can save you from nasty surprises. Be cautious with after-hours trading, though. While it's tempting to jump into the fray during pre-market or after-hours sessions, remember that these periods are highly unpredictable. Stick to your long-term strategy unless you have a compelling reason to deviate. Diversification is another key tool. Spread your investments across different sectors and asset classes to mitigate risk. This way, if one stock tanks overnight, your entire portfolio won't suffer. Finally, monitor global events. Pay attention to international developments that could impact US markets. Understanding the bigger picture can give you an edge as an investor. Now, I know what some of you might be thinking. Iggy, isn't it risky to rely on overnight gains? Absolutely. While overnight movements can work in your favor, they can also go against you. Remember, markets are inherently unpredictable, and trying to time them perfectly is a fool's errand. Instead, focus on building a solid foundation for your portfolio. Invest in quality companies with strong fundamentals, maintain a diversified mix, and stay disciplined. Over time, these principles will serve you far better than chasing short-term gains. So there you have it. The mystery of overnight stock gains demystified. Whether it's earnings reports, global market shifts, or algorithmic trading, there's always something happening behind the scenes, even when the markets are closed. By staying informed and adopting smart strategies, you can navigate these dynamics with confidence. Before I wrap up, here's my challenge to you. Pick one actionable tip from today's video and implement it in your investment routine. Maybe it's setting up alerts for earnings reports or brushing up on global economics. Small steps add up over time. If you enjoyed this deep dive, check out my video on how to build a winning portfolio in 5 simple steps. It's packed with practical advice to help you achieve your financial goals. Thanks for tuning in, friends. Don't forget to hit that like button, subscribe to the channel, and ring the notification bell so you never miss an update. Investing is a journey, and I'm honored to be part of yours. Until next time, stay curious, stay disciplined, and keep growing your wealth. See you soon.